Do you think after investing in something like Nifty 500, I could perhaps start looking at debt instruments directly, does it come way later?
No, I think debt is important. Debt acts as a natural hedge,
Okay.
when your equity portfolio is not doing well.
Okay.
So I think having fixed income in your portfolio is very important.
Yeah.
When you're choosing debt investments, from a passive standpoint, there are two different types of debt fund that you could buy.
Okay.
One is called a target maturity fund, and the
Yeah.
other one is, say, a normal debt fund.
Okay.
And the main difference between these two categories is that in a target maturity fund,
Hmm.
you basically can lock in your returns
Okay.
today, and you can. So, for example, there's a target maturity fund that matures in 2030, and your current yield is about, say, 7%.
Yeah.
So it's like almost like buying an FD, but in a mutual fund space.
Okay.
Whereas in a non-target maturity or a normal debt fund,
Yeah.
you're basically relying. It's a perpetual debt fund.
Okay.
So basically, you don't have to worry about the fund expiring.
Hmm.
You're basically investing in a very low risk, sort of perpetual debt portfolio,
Okay.
which will give you that 5 to 7, 5 to 8% returns over time.
Okay.
So we believe that building a portfolio, if you're, say, investing for a goal in mind,
Yeah.
then you should probably look for target maturity.
Okay.
But if you're building a portfolio, I think a normal debt fund
Like
works
if you
very
have a
well.
fixed date saying that in 5 years I'm going to do this, and you
Exactly.
definitely need that money,
Yeah,
then you can put something like that.
exactly.
But the way you've answered it also made me realize that they're very different from equity funds, right?
Yeah.
So would you like to elaborate a little bit about how debt funds work actually?
Yeah.
Because I think the fact that they can give you fixed returns means that there's something not similar to equity funds, right?
Yeah, so debt funds may you're buying, it's basically you're buying fixed income instruments. So the idea behind debt funds is that your sources of income is
Yeah.
going to come from coupon payments.
Okay.
So if you're buying a government security, you're putting in principal amount of, say,
Hmm.
1 crore, and every year you will get 5%, say,
Huh.
5 lakhs from that. So that income is very streamlined.
Yes.
But it's very important for investors to understand that not all debt funds are equal.
Okay.
You have to also look at duration, which is a complicated sort of concept, but it's very
Yeah.
important for investors to understand that debt funds are not free of risk.
Okay.
Just because they're debt fund doesn't mean they're risk free.
Okay.
They have something called interest rate risk.
Acha.
What that means is that if you're buying a debt fund
Hmm.
which has a very high duration, so if you're buying, say, companies or debt papers that
Yeah.
are maturing in 10, 15, 20 years,
Yeah.
then they have a lot of sensitivity to interest rates.
Okay.
So I think investors who are looking at debt funds should ideally stick with a very simple debt fund. So at
Okay.
Motilal Oswal, we have something called a 5-year GSEC,
Okay.
which is a very simple debt fund that investors can invest in. They don't have to worry about interest rate risk or lower returns. It's a very sort of sweet spot.
Okay.
But also investors should so basically understand what is the risk profile in debt also.
Okay.
It's not just free. And in debt funds, obviously passive funds offer a lot of simplicity.
Yes. I can look at the entire process of building a portfolio is the base or the foundation has to be something that you secure very well, so that you know that there's not too much risk, and then you can take risk on top of it. The first step was looking into something like Nifty 500, and then when you have fixed income instruments like these ensure that long-term journey of your portfolio is safe.
Exactly.
Would you like to
Yeah,
elaborate
so
a
the
little
whole
bit?
idea behind debt funds actually is to really lower the volatility of our equity portfolio, I would
Okay.
say, in my definition, because what we've seen is that there are certain years when equity funds perform badly,
Yeah.
and then that's when your debt fund shine. So I think the usefulness of a debt fund is to really manage risk in your portfolio. If you are a
Okay.
conservative investor, then you can lower your equity component,
Okay.
but the balance can go in debt.
Makes
Whereas if you're an
sense.
aggressive investor, most of your capital can be invested in equity,
Yeah.
and the balance can be in debt.
Okay.
So I think it can be a great way of risk management in your sort of overall portfolio.
Okay. Does commodity work the similar way? Because a lot of people also say that commodities also act as an hedge
Yeah.
to equity. How do they stand? Like, how different is commodity then?
Yeah, so I definitely think that commodities are also excellent asset classes to have in your portfolio.
Yeah.
I think something like a gold and silver. Again, as I said, when equity markets do badly, debt is there, and then you have other asset classes like commodities, which also moves in different cycles. For example, gold.
Yeah.
Gold, what we've seen historically is that gold tends to do really well when markets are bad.
Yeah.
So I think it could be a natural hedge towards, I think, towards like withstanding poor market conditions.
Okay.
So I think just like debt, commodities can also be one such asset class that can give you good returns, when equity markets don't fail. Also, commodities tend to be, at least in a country like India, it tends to have very emotional value, like gold
Yeah.
and silver. So I think the acceptability of people buying gold and silver goes up dramatically via gold and silver, and you can buy gold and silver via simple ETFs or index funds. So I think commodity funds again offer you diversification, offer you, and what we've seen over the last 15-20 years is that even the return profile of commodity funds have done well.
Okay.
So I think not only has it sort of delivered good returns, it's also helped investors from I think getting some sort of downside protection.
Okay.
So I think overall we sort of advise investors to have a multi-asset portfolio,
Okay.
which is a combination of equity, debt, commodities.